have very high loss, right? Volatility captures this. It captures, for example, how much your stock portfolio would vary. Okay? In here we have the index from the FTSE 100, the biggest 100 companies in the London Stock Exchange. As you can see, what does it look like? What kind of time series it looks like? A random walk. Can you see that a bit? Yeah. For this period, it looks very much like a random walk. Now, I excluded the recent year because it had gone up very good recently, but I intentionally ignore that. It looks very much like a random walk in this case. Yeah. And what does it mean by a random walk? It is random. It's very difficult for us to make a prediction of what's next. Okay, so trading is not an easy job. If I can do it well, I'm not going to be here with you guys, right? I'm gonna retire. So, for example, here we have many shocks around the last 20 years that can affect the UK stock market. Okay. So, if you recall, a random walk is a non-stationary process, and we don't like non-stationarity. We transform it into the returns. Okay? And what do you think about this? More stationary, right? It looks more stationary to us, right? So again, if you want to make a prediction on your return, because it looks like a white noise, again, pretty much quite unpredictable, right? But what is good about stationarity? Remember, the good thing about stationarity is that the statistical properties would not depend on time. Meaning that if we learn about the variance, well, we all know that the daily return would be around 0, so it doesn't really give us any advantage, right? The second thing about stationarity is that the variance would not be dependent on time. It means if we can learn to master the variance of this time series, we can sort of apply it in the future. Are you guys with me? I'm giving you trading advice here, right? Because this is a stationary process. The variance, if we look at sometimes in the past, it would repeat in the future. Why? Because the variance should not be dependent on time. So whenever we look at it, it would be repeating in the future, and it should have happened in the past already. Okay? So we can actually look at the variances of the time series. We call it volatilities. Okay? So the volatility would show us, some pockets that can be quite, there may be some pattern, but the pattern should not be dependent on time. So for example, this period, 3 periods, we call it the high volatility periods. Okay? And there will be some other low volatility periods. So now it will depend on, it will depend on the kind of investors you are to be interested in these volatilities. If you prefer, high risk and you are tolerating low or even, very much high loss, then you would want to be in those high volatility periods. Right? But you are a little bit more, risk adverse. You want to have a more sort of stable portfolio returns. Then you want to trade less during the high volatility, right? And maybe spend more or invest or trade more during the low volatility periods. Okay? So I'm trying to motivate why volatility clustering is a very fruitful area of research. Okay? It is so important that Engel won the Nobel Prize in Economics for studies in this topic. Okay? So what he was trying to do was that we know that the mean or the actual daily returns would be impossible to forecast. But what we can do is we can actually make the forecast on the variances. okay? And the variances would capture the risks of a portfolio. And for people and for many, fund managers, they are important enough. We want to make sure how we can manage the risk, okay? You can think about, the volatility as the measure of the risk, so that, risk-adverse investors can avoid the periods of high volatility. Not sure if you have seen this Black-Scholes formula. No, for those of you who've done some finance course, you have seen it. So for assets pricing, this is like the mathematical Bible, right? It's the foundation for assets pricing. So in the 1970s, 80s, they all won the Nobel Prize in economics for it, okay? But you know what? What happened is that when they actually tried to set up an investment fund with a colleague at the LBS, the London Business School, they actually lost money. They didn't do very well. They came up with the asset pricing formula, but when they actually do it, they actually lost money. Okay? Not many people can be, a Renaissance fund, right? So, but the problem here is that, volatility can be linked directly to the price of some assets. Okay? So if you are familiar with the Black-Scholes formula, you will know this. So you can help with performing better in terms of our forecasting as well. Now, again, let me just do a very quick summary of what's going on. Let's say we have stock price return. If we start with a very simple description of the returns, in this case, a white noise, okay, together with some constant. You remember the graph? It was a white noise, okay. If we relax the assumption that the error term is homoscedastic, remember the concept of homoscedasticity from term 1, yeah? Meaning that the variation would not be dependent on the other factors. If we relax that and we're trying to model this, so instead of trying to make a prediction on YT, we want to make a prediction on sigma squared, the variance. We need a model for it. So the model is going to be the variance of UT based on the information of UT minus 1, UT minus 2, and so on. So how can we do this? To do this, we're going to use the model of Engel in 1982. He won a Nobel Prize in economics for this model. Okay? So this is the model. They call it an arch model. Autoregressive. So we are going to use, the error term on itself to explain what's going on. Autoregressive. Conditional. Heteroscedasticity. So we're trying to explain sigma t squared by using the previous value of sigma squared. Okay, in this case, we're going to be using the error terms in the last periods. So that is the key idea. Okay. So the higher the higher the volatility in the last period can result into a clustering in the next period. Okay. This is the pattern of a stationary process. Okay. So how can we perform this? Very simple. We're going to try to make a prediction of the next period volatility based on the past error terms. Now, the problem with this method is that we can never observe the error terms. So how can we go about it? We use the residual instead of the error terms. Okay? So when we square the residual, essentially we are using the past volatility to make a prediction of the new volatility. Okay, I'm not sure how much you are interested, but let me finish this and then we go home, yeah? So, let me say this. The key idea behind this Nobel Prize winning theory is that we can think about the volatility as a normal time series, and we can express it in terms of an AR1 structure. So you think about this as an AR1 model for sigma squared, right? Do you see this very, very familiar? It is essentially an AR1 model for sigma squared, okay? But instead of using a normal time series, we're using the conditional heteroscedasticity. Now, everything you learned before applies. Everything you learned before applies, okay, in terms of the AR model. You can then also obviously expand it into P lags by including the P periods of the residuals, okay? So you can expand it exactly the same way as you expand AR1 to ARP, okay? Now, people then went above this a little bit by saying, okay, so here I'm actually looking at all of the information in the last period. How about I can augment this a little bit by fixing the conditional expectation of the heteroscedasticity. To do this, they're going to add not just the residual, but also the variance of the residual into the model. They call it GARCH model, generalized arch model. Okay, so they add the actual volatility into the model together with the error terms. Okay. Now, obviously, we would need some condition for this to be stationary, exactly the same as AR1 structure. I talk more about it in the pre-recorded lecture. Now, the final comments. I think it's interesting. Maybe in the future you will be using it. There are many ways that there are many things we need to do when we do the selection of P for the arch and for the GARCH model, okay? One way is to use the BIC and AIC method, exactly the same as we do with the AR structure, okay? We choose the one with the lowest BIC and or BIC. So you can choose the P using the methods that we learned. We can also expand the uses of this to other time series, not just stock price. It can be applied for example, GDP, even for inflation, right? Inflation measuring the volatility of price, but we can actually measure the volatility of the price. Very important. Why? Because interest rate decisions are based on inflation. So we may want to see how stable the monetary policy is. Okay, so very important. Now, for those of you who are interested, this is still not a finished area of research. Okay, in the future you will learn more about this. It could be threshold gauge, in which you impose a threshold of volatility into the model. We call it T gauge. You can also account for some nonlinearity in the model. We call it N gauge. Or you can add in some exponential, for example, E gauge. Okay. Some people have come up with some Bayesian methods on this, and they call it B gauge. Okay.
For the negative, I'm going to start comparing the negative and the positive notch. When did they access? How many days after the notch did they access the videos? The percentage of the video they watch, how much time they spend on these videos. First is that average time here is that those that receive the positive notch, well, in general, the students in the model where we use the positive notch, in general, were more engaged. There's more access. They watch the videos earlier, and they watch more percentage and spend more time. Yeah.
So one clarification.
Yeah.
At the number of days. So is it 45 days? You send the nudge in 45 days later they keep on?
Yeah, because, well, obviously this is a reflection of, if I release it, say, in October, and some of the early watchers might watch that week, but a lot of them watch for the exam.
Okay.
Yeah. So yeah. Now, in terms of whether the treatment is effective on this group, there's nothing on the positive model where we use the positive notch. The bars are very close, confidence intervals clearly overlap. Now, if we look at the model where we use the negative framing, what we see is that it actually worked to get the students to watch a greater proportion and to spend more time watching the videos. This is about 3-4 percentage points more, and this is about 1 minute more watching, but when they're watching just below 5 minutes, well, 1 extra minute, I would argue, is considerable. What this is telling us is that something that we already know, that they probably care more about the losses than the gains. So when you tell them that if they don't participate, they are going to get an average that is 5% below those that participate, it motivates them more than when you tell them, oh, you're going to be 5% better off. In terms of the social norm, if you want, we can talk afterwards. The familiarity, similar picture again. How many times they access, how many days, percentage and time they spend on the videos. In this case, we managed to get significant treatment effects in time, so in action time and the percentage time they spend on our videos. 2 minutes. Okay, thank you. And yeah.
Sorry, just a little bit puzzled. You've got, so within the positive people, you've got control and treated. I thought positive versus negative was your treatments or control.
No, so we have the positive treatment. In the positive treatment, we told the students, we know from previous experience that if you participate on this feedback opportunity, or students that participated in this feedback opportunity got on average a grade that was 5% greater than those that didn't participate. Negative treatment, it was the contrary. Those that don't participate do 5% worse in the exam. A social norm message, so last year about 87% of students had a look at the video answers to create this sort of pressure, social pressure. And finally, a familiarity notch where we are, instead of saying dear students, we have personalized email using mail merge where we said dear Antonio, dear John, dear Mary, and then every week we were saying something else like I hope you're enjoying the model, I hope you're okay, so to create some sort of informality affinity with the student. And then we were monitoring these 4 key outcome measures, of measures of engagement if you want. How many times did the students access our videos? How much time they needed to watch the video from the moment we told them the video was out, so the action time, what percentage of the videos they watch in average, and how much time they spend watching the videos. So we have these 4 measures. And this was all collected by our university virtual system, so it was already there. We just needed to get ethical permission to access it, so we got this in 2023. We also in 2023 we got the EEA Silicon grant that helped us fund for a year the research assistant. So that was very useful. If anyone in the room was involved on that decision, thank you very much. And so we have our 4 notches. So just to give you a broad overview of the number of students and the years in which this happened. So most of our data collection took place in year 2 and 3, although we also have a bit in year 1. And for all of the notches, we had more than 300 students and above, which help us to get rid of a bit of the noise and get a narrower confidence intervals and so on. In terms of the percentage of students in the models that watch the videos, it varies quite, this called with a percentage, it varies quite a bit depending on the model. We think this varies depending on whether the model is a compulsory model, whether it's an optional, and so on. What matters is how does your treatment group does compared to your control. So let's have a look at that.